We are looking at the final week of July 2026, specifically inside the Indian market for biaxially oriented polypropylene, or BOPP, films. This digital readout tracks baseline pricing for 31 to 50 micron BOPP TT film in Ahmedabad. The official company price sits at 169 rupees per kilogram, while the open bazaar is quoting 171 to 172 rupees. This creates a precise 2 to 3 rupee premium for buyers forced to source material directly from the open market. This specific market snapshot comes directly from Polymer Bazaar's late July weekly report on BOPP film trends. In industrial commodity markets, an open market premium like this typically signals a healthy supply chain where downstream converters are willing to pay extra to secure material for robust production schedules. The reality on the ground is the opposite. Converter inventories are depleted, and they are buying out of necessity to fulfill existing orders rather than projecting growth. The current premium is a localized anomaly, representing a temporary supply gap rather than a recovery in market health. While geopolitical volatility has increased raw material costs, this price gap is primarily the result of a supply-side squeeze. To understand when this price bubble will burst, we need to deconstruct the current supply chain, tracing how material allocations, raw material spreads, and incoming cargo routes are interacting to cap the market. Misreading this supply squeeze as long-term structural demand will lead procurement teams to lock in high prices now, resulting in costly errors heading into the third quarter. Domestic buying activity for TT grades has spiked in the open bazaar, but this is a direct reaction to delayed deliveries from domestic producers. Right now, producers are prioritizing NTT grades for export markets, draining the majority of available production capacity away from domestic fulfillment. They are following global market realizations, which currently offer higher financial returns than domestic contracts. This leaves only a small volume of material allocated for the domestic bazaar. Fresh supplies are strictly limited to older commitments, leaving recently placed domestic orders in a stagnant queue. Producers have also avoided communicating any immediate delivery schedules for these pending domestic orders. This manufactured scarcity forces converters into the open bazaar to secure whatever material they can find to keep their plants running. This panic-driven procurement is what sustains the 2 to 3 rupee premium. The elevated domestic price is an outcome of producer allocation choices, disconnected from organic growth in domestic consumer demand. A second, highly critical factor sustaining this entire pricing environment is the relationship between official producer prices and the underlying raw material feedstock costs. In early July, feedstock costs saw significant downward corrections. Meanwhile, the official BOPP company price remained flat at 169 rupees. This increased the profit spread for producers. By holding official prices steady while feedstock costs fell, producers secured healthy profit margins throughout the first half of the month. Recently, shifting geopolitical developments have caused raw material prices to reverse trend and rise. This spike in feedstock costs is now compressing that profit spread back toward historical averages. Even with this normalization, producers maintain favorable operating profitability. Because their base margins remain safe, producers have no immediate pressure to announce official price revisions or chase the open market premium. Producers are protecting their baseline margins by holding official prices steady, even as the open bazaar climbs and the export market runs hot. This domestic supply squeeze is approaching a definitive endpoint. Lower-priced import bookings finalized back in June are currently in transit from China and Southeast Asia. These vessels are carrying high volumes of commodity-grade BOPP films, specifically the TT and NTT grades currently in short supply domestically. These shipments will begin arriving at Indian ports in August. This massive influx of foreign volume will abruptly correct the domestic shortage, shifting the supply-demand balance back in favor of the buyer. Traders are moving to exploit this shift, evaluating larger volumes to capitalize on the price difference between cheap Asian imports and the inflated Indian bazaar. This arbitrage window only exists until domestic producer supplies return to normal. That normalization begins as soon as producers fulfill their current international export commitments. Once those orders clear, producers will likely shift their output capacity back toward the domestic bazaar to maintain plant operating rates. The market will soon face a dual wave of imported cargo and renewed domestic capacity, arriving while converter demand remains weak. The August import wave sets a ceiling on how high the open bazaar premium can go. Buyers also have a structural failsafe against inflated pricing: material substitution. This matrix maps incoming import volumes against the widening price differential between BOPP and alternative BOPET films. In applications where the economics permit, cost-sensitive converters will switch materials if the price gap between BOPP and BOBET grows too large. If BOPP prices remain high in the open bazaar, converters will pull the trigger on substitutions to protect margins. This creates a strategic risk for BOPP producers who might consider official price increases. Based on these factors, Polymer Bazaar recommends that producers maintain stable price levels rather than chasing the 172 rupee peak. Stable pricing secures long-term order inflows and minimizes market volatility. It also keeps domestic material competitive enough to discourage traders from seeking excessive long-term import arbitrage. 3 variables will dictate the August market: raw material movements, the volume of Asian imports, and the end of export allocations. Sustainable market equilibrium relies on a recovery in actual domestic demand, not on the panic-driven buying caused by current delivery delays. The July premium is the result of temporary supply factors. Surviving the next quarter requires navigating the August arbitrage window before the current demand narrative collapses.